Vietnam's economy in 2026. Prospectus, development drivers and challenges. Mr. Phung Xuan Minh, Chairman of the Board of Directors of PT Group and Saigon Ratings. 2026 is considered a pivotal year for the Vietnamese economy, as it enters the first year of the 2026 to 2030 socio-economic development plan amid significant global economic volatility. Slowing global trade growth, increased geopolitical tensions, risks to energy prices, inflation, and continued protectionist trends are creating considerable pressure on highly open economies like Vietnam. However, alongside the challenges, Vietnam still faces significant opportunities to restructure its growth model, enhance productivity, and strengthen national competitiveness. Traditional drivers such as exports, public investment, FDI, and industrial production need to be revitalized, while new drivers such as the green economy, digital economy, knowledge economy, and innovation will play an increasingly important role. This article analyzes the prospects, development goals, growth drivers, as well as the difficulties, challenges, and risks of the Vietnamese economy in 2026. 1. Global Economic Forecast for 2026. Entering 2026, the global economy is projected to continue operating in a volatile environment, influenced by a complex interplay of geopolitical, trade, financial, energy, and technological factors. International organizations such as the IMF, World Bank, and UN all acknowledge that global trade growth is trending slower compared to the previous recovery period. While global inflation is expected to continue to decline, the rate of reduction will be uneven across regions, while risks from trade policies, geopolitical conflicts, and commodity price volatility remain. One of the major risks to the global economy is the potential for supply chain disruptions and oil price volatility. If conflicts in the Middle East continue to escalate, particularly affecting key energy transportation routes, oil prices could rise sharply, leading to increased global production, transportation, and logistics costs. For Vietnam, a highly open economy, external shocks can quickly propagate domestically through import prices, input costs, and inflation expectations. Furthermore, the global economy is facing structural changes. Geopolitical and geo-economic competition is increasing. Protectionist trade trends are becoming more pronounced, while the wave of investment in artificial intelligence, high technology, and digital assets both opens up new growth opportunities and poses the risk of asset bubbles. Global monetary policy is expected to continue its cautious easing as many central banks gradually cut interest rates. However, this only helps support capital and credit flows, and is not enough to completely eliminate the risk of slowing growth. 2. Economic development goals for 2026. Against the backdrop of global economic uncertainty, Vietnam enters 2026 with the goal of achieving high economic growth, aiming to lay the foundation for the 2026 to 2030 five-year plan. This is not only a target for GDP growth rate, but also a requirement to improve the quality of growth, consolidate macroeconomic stability, and strengthen the resilience of the economy. Positive growth results in 2025 are an important prerequisite for Vietnam to maintain growth expectations in 2026. Drivers such as industrial production, exports, attracting foreign direct investment, dispersing public investment, and the recovery of international tourism have contributed to laying the foundation for the economy. However, traditional drivers are gradually losing their effectiveness, while pressures from costs, inflation, slow recovery of consumer demand, and dependence on the FDI sector are becoming increasingly apparent. To achieve its economic development goals by 2026, Vietnam needs to continue maintaining macroeconomic stability, controlling inflation, and ensuring a favorable environment for production and business. Fiscal policy should be managed proactively, focusing on development investment, especially in transportation infrastructure, energy, logistics, and digital transformation. Accelerating public investment disbursement will not only stimulate aggregate demand, but also create long-term growth potential by reducing transportation costs, improving regional connectivity, and enhancing the efficiency of resource allocation. Simultaneously, monetary policy needs to be flexible, prudent, and closely coordinated with fiscal policy. Controlling inflation, stabilizing exchange rates, ensuring liquidity in the financial system, and directing credit towards the production and business sectors will be crucial factors in strengthening market and investor confidence. 3. Vietnam's economic outlook for 2026. Vietnam's economic outlook for 2026 is considered positive, but not without challenges. Some international organizations forecast that Vietnam's growth may be lower than in 2025 before recovering in 2027. These forecasts range from 6% to 7.6%, reflecting differences in assessments of export sustainability, domestic demand, resilience, and policy effectiveness. From a positive perspective, Vietnam continues to benefit from the restructuring of global supply chains and the China Plus One strategy. Its favorable geographical location, stable political environment, extensive network of free trade agreements, and increasingly improved production capacity make Vietnam an attractive destination for FDI in Southeast Asia. Sectors such as electronics, semiconductors, clean energy, logistics, smart manufacturing, and high technology are expected to continue attracting the attention of international investors. However, the Vietnamese economy also faces structural constraints that require more decisive action. Growth remains heavily dependent on exports and the FDI sector, while domestic businesses have not yet deeply integrated into global value chains. Domestic consumer demand recovery is not yet truly robust, input cost pressures remain significant, and the risk of a trade deficit returning at certain times remains. This suggests that the outlook for 2026 lies not only in the ability to maintain growth rates, but also in the capacity to transform the development model. Vietnam needs to increase the technological content, added value, and productivity in each economic sector. If institutional reforms, improvements in human resource quality, and the promotion of innovation are effectively implemented, the economy can enter a new, more sustainable growth cycle. 4. Drivers of economic growth in 2026. In 2026, Vietnam's growth drivers are expected to come from a combination of renewing traditional drivers and exploring new ones. Three key pillars: infrastructure investment, attracting high-quality FDI, and developing the capital market, will continue to play a fundamental role. Among these, transportation infrastructure, logistics, energy, and digital transformation are areas with the potential to create significant spillover effects on national productivity and competitiveness. Besides traditional drivers, three new drivers: the green economy, the digital economy, and the knowledge economy will play an increasingly important role. The green economy helps Vietnam adapt to the requirements of sustainable development, reducing risks from emission standards and green trade barriers. The digital economy creates new growth opportunities through e-commerce, data, artificial intelligence, digital finance, and automation. The knowledge economy helps enhance technological capabilities, promote innovation, and increase product value. To maximize the effectiveness of these drivers, Vietnam needs stronger institutional reforms. A transparent legal environment, streamlined administrative procedures, low compliance costs, and better access to capital will help businesses expand investment. Simultaneously, it is necessary to develop the science and technology market, support the startup ecosystem, and strengthen public-private partnerships in innovation. 5. Difficulties, challenges, and risks in 2026. Entering 2026, the Vietnamese economy faces a crucial transitional period, marking the beginning of the 2026 to 2030 socio-economic development plan, while simultaneously confronting numerous challenges from the global economic environment. This is a time when the economy must maintain high growth momentum, control inflation, stabilize exchange rates, ensure the safety of the financial system, and improve the quality of growth. The biggest challenge comes from the external context. Global growth tends to slow, international trade is declining, geopolitical tensions are increasing, and tariff policies from major economies could reduce export demand. With a very open economy, Vietnam is unlikely to avoid the impact of weakening key markets such as the US, EU, and China. New trade barriers, especially green standards, carbon border adjustments, and rules of origin, will add further cost pressure for export businesses. Besides external risks, the economy also reveals many internal bottlenecks. The growth model remains heavily dependent on FDI, exports, investment capital, and cheap labor. Meanwhile, labor productivity, total factor productivity, and technological innovation capabilities have not yet achieved breakthroughs commensurate with the demands of high growth. Domestic businesses, especially small and medium-sized enterprises, still have limitations in management capacity, technology, capital, and the ability to participate deeply in global value chains. The target of double-digit growth in 2026 is therefore a very challenging task. To achieve this goal, Vietnam cannot rely solely on expanding public investment, increasing credit, or attracting FDI extensively. The economy needs a new growth engine based on institutional reform, improved capital efficiency, private sector development, digital transformation, green transformation, and the promotion of innovation. Another notable risk lies in the financial system. High credit growth may support economic recovery, but it also increases pressure on the quality of bank assets, especially given the unresolved issue of non-performing loans related to real estate and corporate bonds. If capital continues to flow strongly into asset sectors instead of production and business activities, the risk of a mismatch between credit growth and the economy's actual absorption capacity will increase. Exchange rate, interest rate, and inflation pressures also pose a difficult challenge for macroeconomic management. The State Bank of Vietnam must balance the requirement to maintain interest rates that support growth with the task of stabilizing the exchange rate, controlling inflation, and limiting capital flow risks. Meanwhile, the room for further monetary policy easing is shrinking, forcing fiscal policy to play a more proactive role in supporting aggregate demand, investing in infrastructure, and reducing costs for businesses. Furthermore, bottlenecks in transportation infrastructure, logistics, energy, and capital markets remain major obstacles to long-term growth. High logistics costs, energy infrastructure lagging behind the needs of high-tech industries, a slow recovery in the corporate bond market, and the lack of strong domestic capital inflow into the manufacturing sector are issues that need to be addressed comprehensively. To overcome these challenges, Vietnam needs to focus on key solutions. Improving institutions, enhancing the business environment, reducing compliance costs, increasing the efficiency of public investment, developing the capital market, supporting the private sector, and selectively promoting domestic consumption. At the same time, it is necessary to enhance the competitiveness of domestic enterprises, expand export markets, promote the application of technology, and develop high-quality human resources. Overall, 2026 is not only a year of testing macroeconomic management capabilities, but also a pivotal year for Vietnam to build a new growth foundation. If reforms are implemented decisively, the economy could enter the 2026 to 2030 period with higher competitiveness, better quality growth, and greater resilience to global shocks.